We're all familiar with the saying, no risk, no reward. And it is there for a reason, because it's very clear, like in life, the same is true in investing. The more risk you're willing to take, the potentially higher reward you will be getting for that risk. But of course, what you can get in return, you can also have in losses. And again, that is very much true in investing. And that's why in this video, I want to go through the investment risk ladder, where I kind of go through some of the most popular asset and investment classes that people can invest their money in, going all the way from the least risky to the most risky. So you get an idea of, A, what you can invest in, and B, how that correlates with risk, right? Because of course, all of us want higher returns in their portfolio, right? But at the same time, that often comes with additional risk. The question is whether you're willing to take the risk. And for you, you might be willing to take more risk. Maybe you're younger, maybe you have more money to invest and potentially lose, to kind of play with. That's totally fine. While others who are watching, maybe close to retirement age, or in general, more conservative and more risk-averse people, they want to go for less risky asset classes. And that's the beauty of investing. There's no right or wrong. If there was, everybody would be doing the same, but there's so many different choices. It's like a buffet, right? Some people like the one section of the buffet, other people like the other one. That's totally fine. And that's what I really enjoy. You kind of have to find what works for you. So don't let anyone ever tell you online what you should be doing with your money. Understand what you can be doing and then make your own decision. So hopefully that can help you and serve you as a sort of guidance of what you could be expecting when you invest into certain asset class and whether that correlates with your own risk tolerance. Of course, none of this investing advice, ultimately your choice, your money, but hopefully it will be useful for you. Right, and starting off with the first one, which is pretty much what everybody has by default, and that is cash. And I'm not just talking about, hard cash that you keep under your pillow at home. Please don't do that. That wouldn't be the smartest. But even the cash that you keep on your bank, right? In a savings account or what have you. Savings account is already advanced. Too many people, they keep it basically at a standard bank account where they get zero, which is probably the worst. And that's why in this case, I also put it at 0%, because I'm really assuming you're not putting it into any smart high yield savings account. And that, is an option, right? A lot of people who are completely fearful of investing, and you'd be surprised how many people are, they just keep it in cash and think, I'm on the safe side. And well, yeah, technically, of course, you don't have really a negative risk in terms of fluctuation of your money, because it kind of, stays stable or grows if you add more to it. But of course, you have an invisible risk, which makes it even worse. And we heard about it. That's called inflation. So while the actual money in your bank account, if you were not adding anything, stays the same, the purchasing power, what your money buys in 10 years from now, even 5 years from now, will be much less. And we see this every single day, right? When the eggs that we used to buy, the same 6 eggs or 10 eggs that you used to buy 5 years ago would cost you, I don't know, let it be 3, 4 euros, dollars, whatever. Now might be 50% more or 100% more. So you still have the same amount of physical or digital money, whatever, in your account, but now you need much more of that money to afford the same goods that you previously could. It means your money is losing purchasing power. And that's obviously why we invest in the first place. But at the same time, risk-wise, sure, it technically is the least risky one. Of course, as I said, you have inflation and theft also. Carry too much cash on you or at home, somebody breaks in, steals it from you, or the house burns down and you have the cash at home. That's not really advisable. And so even there, you see, at cash, you still have certain risks. So there really isn't any asset class without any risk. Everything comes with some kind of risk. But probably one of the lowest risk level that you can have, but also in terms of return, obviously pretty much nothing unless you put it to work into some high yield savings account, or of course deploy it into the markets or other investment classes, which we'll talk about in a second. With this, we move to government bonds, where basically you lend money to governments around the world, right? You can choose if you want to invest into US government bonds, right? Which traditionally is one of the most safest ones, because they have been always paying back their debt. Unlike maybe your friend that you borrowed money to who forgets about it and kind of delays paying back, governments, they can't really afford that. If they start not paying back debt, obviously that would reflect really badly on them. So those are traditionally seen as very safe investment classes, but therefore also they pay much less return. You can see here, anywhere from 1 to 4, maybe 5%. Also keep in mind, you can choose to give money to some riskier countries, right? Let's say somewhere in emerging countries around the world that have not matured that well. So obviously they will be also paying a premium for you, so you can get a higher return. But then, of course, you have a higher risk of the government not being potentially be able to repay you. So that's something to keep in mind. Once again, risk versus reward. So this is a really predictable form of income that, is a debt for 10, 20 years, depending on what you go for. And a lot of people like that. Again, personally, I don't do that, but it is considered as one of the most safest way to invest your money. Now, closely followed by government bonds, we have corporate bonds. So here we talk about companies, big multinational companies, for example, that issue debt. They basically need more money and they basically issue debt, and you become once again a lender. You give them money and they will pay you an interest in return, right? And well, that could be slightly more profitable or higher returns than on a government bond, but potentially also more risky. Again, depends on which company you go with, right? Most likely a company like Apple, Microsoft, and some of the biggest companies in the world, they will be honoring the debt and pay you back on time and with everything else. However, you also have smaller companies that need money and funds, and they might run into financial issues, right? And maybe they're not profitable anymore, running out of business, and sometimes you might end up not getting all your funds back. So it is slightly more risky, even though, again, if you consider big multinational corporate companies, then you should be in good hands. But also the returns, in my eyes at least, fairly small, 3 to 5%, maybe 6%. Again, these are just average indication. I can't possibly, feature all of them, but just to give you an idea of what you could be expecting. And yeah, that's something for some people that they really like. Next up, we have gold and maybe commodities at large, right? Like silver, aluminum, and all kinds. But I think most popular is gold for people to invest in. And well, I put here the average return 1 to 4%. However, in recent times, it has been actually really well, much higher than that. But I'm just saying, for the last 50 or 60 years, maybe let it be up to 6%. But in general, it's considered a fairly stable investment class, right? It doesn't pay you any income. So if you want, regular passive income from your investments, then obviously gold wouldn't be doing that. And of course, it also has risks, right? There's still price volatility. There's still the risk if you buy physical gold of people stealing it from you. And it's very difficult to transport, right? If you move from one country to another, you have a lot of gold. It will be a bit tricky. You could leave it at the bank, but even banks have been broken into. So, but generally, gold is considered very stable, especially we've seen now in times of fear or potential recession. People flee into gold and invest a lot of money there because it has been seen as an inflation hedge. And in fact, actually, over the last few years, definitely outperformed inflation. I don't invest in gold and I don't like it. I don't see myself ever investing in gold. But I gotta give credit where credit is due. It has performed really well and generally still considered a very safe investment class because it's not like a speculation, right? It's not like moving up and down like crazy. It's been really trending up nicely over time. So generally a good hedge, especially in crises and recessions. With this, we move to the slightly higher category. You can see this here marked in orange. And here we talk about ETFs, right? I'll really talk about broad market ETFs like S&P 500 or all world ETFs that really have a number of different stocks from different industries, either from around the world or a specific market in there. And of course, and generally, they do have a higher return than some of the previous ones we looked at. S&P 500, anywhere from 8 to 10% over the last 30 years or so. And yeah, that's definitely attractive to a lot of investors, right? Myself included. I'm a big fan of the S&P 500. But again, even different ETFs can be part of that. But of course, we also do have to understand that this comes with market volatility, as we've seen the last few months, right? Following Trump's tariffs, we've seen a major sell-off in the markets. People were scared, markets reacted negatively, and we've seen a drop. And I know quite a few people who reach out to me say, Guy, what's happening with my investments? My S&P is dropping big time. And yes, this can happen, much more so than, with bonds or gold or cash. But ETFs can definitely swing, hopefully long-term on the upward trajectory, but they can also go down and have downward correction for quite a period. So you have to be able to stomach that. If you can't, well, then maybe think about whether that should actually be part of your investments. Even though at the same time, you will see we have so many more risky asset classes out there that I, at least in my eyes, still consider it as one of the more safer ones because generally behind those ETFs are companies that are producing revenues, profits, adding value to the world. So for me, it's not just some, random made up, construct of financial ingenuity. It's actual companies producing real life value and money. And I don't see a scenario where that wouldn't be happening anymore. And if it was to happen that, let's say all those 500 companies in the US were to collapse overnight, I guess we would have other problems in the world. So I'm really not too worried about that. But of course, there is a certain risk to it. With this, we move to physical real estate, which again, some people absolutely love, some people don't. And I'm not here to judge. I could talk about each of those asset classes for quite a while. I also happen to own some real estate myself and I love it in a way. But I can also see, some of the shortcomings of it, right? It's very illiquid. If I want to sell my real estate in Dubai today, it would take me some time until I finally have the money in my bank account, right? You have to look for tenants, right? Now, one of my contracts came up. It's a 1-year contract. Now I've been, for like 5 weeks looking for a tenant because I kind of pushed the price high up because, I want to get more rent for my apartment. But that also meant that, for 5 weeks, I didn't get a pay because the apartment was vacant. You have to do renovation once in a while, right? There is something to fix. I need an agency to pay to look after all these sort of, management of the apartments and units. So yeah, that's just something to keep in mind. But generally, over time, real estate has been one of the most time tested and proven asset classes in the world. Again, in terms of returns, it really depends on where you buy, location, taxation of the place where you buy, what kind is it, apartment, villa, is it an upgraded apartment or villa? So there's so many factors into it. It's really hard to estimate, but let it be 5 to 10% on average, really, really average. Obviously, in Dubai, probably higher than if I was to buy in Germany somewhere. The net yield, the net return on my investments. And of course, it depends whether you buy it for yourself, whether you buy it as an investment property. There you have usually the capital appreciation over time, where the value of the apartment or house increases over time. Plus, if you rent it out, you also have the cash flow component in the form of rent, which can definitely be quite attractive. So overall, I think nice investment, but you also have plenty of risks. Next up, we move to dividend stocks. Obviously, we're all familiar with general stock investing, but there's so many different niches inside stocks, right? And one of them are dividend stocks, dividend kings, dividend aristocrats, basically companies that do pay a dividend over time. Most of the US companies, they pay either a monthly or quarterly dividend. That means you as an investor, as a shareholder in the company, will receive, in addition to the share appreciation over time, you will also get parts of the profits of the company that they pay out to shareholders in the form of a dividend. So quite similar to real estate, right? Where you have the capital depreciation instead of the real estate, it will be in the share price. And then you get that cash flow component in the form of dividend. So that can be quite attractive and in a way predictable, because in the case of dividend kings, for example, these are companies that have been paying and increasing their dividends over at least 50 years. So that's really a long period, and that kind of makes you able to predict your potential future income, right? Of course, again, there is a certain risk, because not all companies, even if they paid 50 years a dividend, doesn't mean that they will be able to do so for the next 50 years. Coca-Cola is a great example. Amazing, solid company, and they are one of the few dividend kings. But who knows? I don't know. Maybe in 30 years, everybody will stop drinking Coca-Cola and use any of the other products that they have. Well, then probably their profits are less. That means they will be able to pay less in terms of dividends, or maybe have to cut the dividend at all. Nobody knows, right? It's an assumption. It's unlikely to happen, but it might happen, right? And that's why in terms of returns, they're not too bad. Obviously 6 to 9%. Obviously that's not guaranteed. It depends on which time period you look at, which markets, which companies. But yeah, just something to keep in mind. But there is certainly a risk component to it. Again, he really only focused on dividend companies, which I think makes it more risky than, for example, S&P 500, because there you have growth, you have dividend, you have other individual share companies in there. So a bit more diversified. Here, really focus only on dividend paying companies. And a lot of the tech companies, growth companies, they don't even pay a dividend, right? So you wouldn't be able to invest into those. So they're more stable, more predictable, but of course, at the same time, they're not guaranteeing to paying the dividend for the future. With this, we come to P2P loans, where you basically become the lender, similar to the bonds we spoke about, but instead of lending your money to governments or to corporations, here you basically lend it to individual people or smaller companies that normally don't get a loan very easily. One great example for this is a company called BONDORA, a service I've been using for a while myself. And yep, they pay me 6% per year interest, and it's really easy to use. And basically, I put my money in there, and they will then find investors to lend the money to, charge them even more, and pay me the difference of 6%. So I can definitely recommend them. If you want to check them out, use my link down in the description below, and you get a €5 starting bonus. Though keep in mind, you have to invest with euro currency. Make sure you will be able to transfer euros into that account. So yeah, generally, I've even seen returns up to 14% because it is much more risky, right? Here you're giving money basically to people who maybe didn't get a loan from a normal bank. So the potential risk of a default, meaning the borrower cannot pay back their loan or doesn't want or whatever, is much higher than with the bank, right? So that's something to keep in mind. You do get higher returns, but the risk is also slightly higher. Now, in my eyes, it really is not that bad, because 6% is much more attractive than 0 or 1 or 2%. So I'm happy with a higher return. And right now, when I look at the history, for example, a company like BONDORA, I feel comfortable with it. Now, I wouldn't go to a platform that promised me 14 or 15%, because that would mean that they would charge their borrowers on their platform maybe 20% or even more, which I don't think is sustainable, and it seems a bit off to me. So I wouldn't trust that. But 6%, I know they would be charging maybe 10, 11, 12%, which does seem more reasonable. So it works for me, but once again, you have to find what works for you. With this, we come to the even higher returns, and here we start off with large cap growth stocks. So these are mostly tech stocks, let's say, in the US, companies like Microsoft, Apple, Nvidia, that traditionally really outperformed the S&P 500. They were really the growth engine of those, S&Ps, NASDAQ 100s, all world ETFs. They're really driven by those huge tech companies, large cap. So cap means market capitalization. So here we talk about, companies with a market capitalization or market value of over 100 billion, let's say, or even over 1 trillion. So these can really have huge returns, but of course are also more risky potentially than a broad market ETF, right? Because you're really much more focused, let's say, on tech or specific industries rather than, diversify across different industries, right? So yes, slightly higher returns, but you're also more focused on a specific niche. And if that niche was to do bad for whatever reason, well, then you would also feel it in your portfolio. So again, something to consider. I personally think that, long-term tech is going to be the future, but who knows, right? It may also not be. Then I would also mention alternative investments. And this is kind of a broad term because it can include a lot of things, right? Some people like to invest in fancy watches like Rolex and so on. I only wear a very simple Apple Watch. I like that. But again, if you're into fancy watches and not necessarily to wear, but even just to invest, that can really yield some great returns. My wife has a very nice luxury handbag collection. And actually, when I look at her returns, did really well. I mean, at times outperform my S&P 500 holdings even. So that could work, right? Some people are into art and they get to enjoy it, hang it on their walls, and at the same time benefit from appreciation of the art over time. Now, usually those investments don't have a cash flow component to it. It's just capital appreciation over time. Like gold, for example, right? You would see the price of it increase over time, unlike cash, which decreases in terms of purchasing power over time. Here, the idea is that the value increases over time. But I think it's quite important to really understand what you're doing, right? Because I'm not an expert in any of those things. So I wouldn't put a lot of my money into a watch where I'm just kind of, heard that it might increase in value, but I'm not sure. I think you have to really know what you're doing, plus have a passion from it. Now, if you enjoy watches anyways and you like to wear them and benefit from appreciation, amazing. If you only do it for returns, not sure it's the best. In my eyes, it wouldn't be the preferred investment choice. But I know a lot of people, they like to invest in something that they anyways have a passion for. Plus, of course, benefit from the price appreciation over time. Then we have the next category of stocks, which are small cap, emerging market stocks. Outside the US, maybe you want to invest in some up and coming markets, even like China, for example. Those can really move much more in one day, right? A company worth 2 trillion moves much slower versus a company worth 10 million, let's say, can move in one day by 2 million up or down. So that's a 20% move, which you most likely would never see in a company worth over 1 trillion. So again, here you can have much higher upside, but also a higher downside. So the volatility, the price swing is much higher than with some more large cap companies. With this, we move to the even higher risky category. And I would still put Bitcoin in there, even though in recent years it kind of stabilized. But, in the first few years when you were investing in it, and even you can throw in there, Ethereum and some of the other, more established coins. And again, percentage range is just an indication. Obviously, it changes over time depending on what period you look at. But generally, it's much more lucrative over the longer period. At least it has been, than some of the other investments. But definitely, you can also imagine the volatility, the price swings are significantly higher than some of the safer and less risky investments. So again, it's something you have to see how much you can stomach of the volatility. I remember the first time when I opened my portfolio and I lost, I think it was like the highest, was like 15,000. I lost in a matter of 1 or 2 days. I mean, that was tough, right? But at the same time, I knew that long term I'm investing into something where I can see the value appreciating. And I just didn't look at it until the prices came back. And if you can't stomach that or handle that, then that asset class certainly won't be for you. But if you believe in it long term and you're fine with both price swings in both directions, then it can potentially be a really lucrative investment for you long term. With this, we move to the altcoins. You probably heard about this. These are more speculative coins where people see potential because maybe they have a certain application or use case that people think that's going to be the future, right? When you talk about Solana or XRP or some of the other coins that are kind of known, but maybe not as big as, for example, Bitcoin and Ethereum. You can think about like large cap when we talk about stocks, right? With huge valuations versus small caps, and the small caps would be altcoins because they are much smaller in value, which also means they have a much bigger potential upside to grow in the future. But of course also, they could really massively drop in value. Again, the price swings are even more pronounced than in the case of Bitcoin or Ethereum. And that brings me to the last one, and that's meme coins or meme stocks. And they are extremely highly volatile and speculative. Obviously, they can absolutely explode, right? We talk about even Trump coin and some of the other random coins we've seen in the past, Pepper coin, and so many really random coins that have literally zero value. It's pure speculation, riding the wave. When everybody jumps on it, you hope to be the first one on there and the first one to jump off when you made your profits. But obviously, that can go absolutely to zero. There's so much scam out there. And again, that's really not something I would be investing in. I can't say I never did, because I did try it and I failed. I made some money until I didn't, and I learned my lessons. And definitely I would really recommend you to stay away from it. Or if you wanted to try it, put a small percentage of it, because this is extremely risky and it's pretty much the same as gambling, right? So I would really not recommend that. I wouldn't call it investing. Up to Bitcoin, maybe even altcoins, I could still understand investments, because you could have an investment thesis. I just don't see an investment thesis on meme coins or meme stocks. It's absolutely just speculating and trying to outsmart and outtime other investors. If you want to try it, fine. Maybe you want to give it a go, but only put a very small amount of money that you can afford to lose, because here you can really look at the potential total loss of your invested capital. Well, there you have it. I hope you found this useful. And it's always a good reminder to kind of see what are the different asset classes and the potential returns. And of course, also risk, right? Because we always look at returns and we want to have the asset class with the potential highest return. But keep in mind that higher returns always come with higher risk. So I'm really interested to hear from you. Which of those asset classes do you resonate most with, that you want to invest, already investing in? And which ones would you stay away from? Let me know in the comments down below. Excited to hear from you. Next up, check out this video right here. As always, thanks for watching. Stay healthy, get wealthy, and I'll see you in the next one. Ciao.